Welcome. Can everyone hear me? A private equity executive, a corporate executive, an entrepreneur, and a banker walk into a bar. I put that into ChatGPT and nothing came out that was worthy. But what it's, to me, is I'm excited because of the perspectives that we have here as we begin to talk about kind of the investor economics and kind of the marketplace of streaming today. My name's Richard Glosser. I'm managing director at Oaklins, DeSilva, Phillips. We're a boutique investment bank in New York City, focused on media marketing technology. I have a long background in television and video and digital media that I bring as a way to help service our clients. I'm honored to have this group and will allow Michelle and Scott and Baskar to introduce themselves.
Well, good afternoon. I am Michelle Noon, founder and managing partner of Clearhaven Partners. We are a private equity firm based in Boston. We focus 100% of our time on software businesses. And within that universe, we spend our time very thematically. One of our major themes is a theme around data proliferation, video content. So we have several investments in our portfolio that fall in that category and always looking for great opportunities to put our capital to work.
Scott Shapiro, I'm EVP of Corp Dev and Strategy for Sinclair. We're based in Baltimore, Maryland, predominantly a media company, although we do own and invest in a number of other verticals, lots of television stations. We own the tennis channel, a few other odds and ends, but great to be here. Thanks for having me.
Hi, this is Baskar. I'm co-founder and CEO of Amagi. We are a media technology company, essentially enabling TV networks, broadcasters, media, anybody who has content to be able to take their content, process it, distribute it, and monetize it across. We're a cloud-first company, so everything happens on a SaaS model, and we'll talk about that today, but yeah, that's what we do. We are headquartered in Bangalore, in India, and we have offices across the globe. US is the largest market. We serve customers like Sinclair, NBC, DAZN, some of the larger names in the business, where we provide them the cloud infrastructure that enables them to kind of move their media operations to the cloud. That's what we do.
Great. So before we jump in, just kind of want to do a quick survey, audience survey. How many here are working at a streaming technology company? How many here are an investor in the category? And how many here are a professional sports athlete? No. Okay. So I think we kind of shaped. So I'm optimistic about the markets. I think what I've seen from some of the data that came out at the end of the year and even into the first quarter suggests that interest rates are kind of holding and there's more optimism. The IPO market is starting to show signs of life with Reddit and others. I read yesterday Goldman Sachs had a blowout quarter in terms of their business. It seems to me that things are opening up, that and I'll also say just in the last 2 days of meetings with CEOs of companies here on the floor, it seems like business is upticking, it's getting written. Buyers are beginning to make more commitments. That's my view. What are you seeing and hearing in your own business or from your perspective? Baskar?
Yeah, at least as a tech vendor for the industry, we definitely see an uptick. And I think just I was trying to talk to somebody saying that I'm actually seeing an acceleration of trend lines, which I thought is going to take the next 3 to 5 years. A lot of our customers are kind of accelerating their tech spends. Largely, obviously, migrating to cloud is a great story that's kind of playing out. I'm seeing that acceleration starting to happen. There's a lot more optimism in the business that I see, just from an emotional standpoint and what I see. So that's something that's interesting.
Scott?
Yeah, I mean, I think I don't know that we ever saw like a dramatic slowdown in the things that we were looking at and considering. All, just the hurdle to do things got a little bit higher. But we still, certainly the last couple months, there's been a pickup in what you traditionally see, at least at companies like Sinclair, which are opportunities to gain scale in various verticals, and those are definitely picking up with some pace here in the last couple months.
Particularly in a political election year for the advertising that your stations get. I'm sure there's a lot of optimism in Baltimore around that. Yeah.
It's, even years are good years, generally speaking. So,
Michelle?
So I'm optimistic about this space and about the markets generally. I think, though, that the sentiment here is not as optimistic as I think I am, based on what I've been picking up from the conference. And there's smaller data points that we see emerging for reason for optimism, but it's not as ubiquitous as I think folks want to see, and we all want to see in order to call it a trend. And when I say the smaller data points, I'm talking about, when we look at across our portfolio, we see bookings beating plan in Q1. More than half of our companies were hit bookings ahead of their plan in Q1. But that's not a trend, that's a quarter, right? So I think there's gonna be a slower return. It's not a V-shaped type of recovery. There's gonna be a slower return on the one hand. And I would say, because we do invest across industries, that I actually feel a little more pessimism coming from the video landscape than I do see in other verticals that we invest. I don't think it's totally justified, frankly. It's almost as if the 2021 boom party, which wasn't real, by the way, it was a point in time, folks are still trying to recover from that. Some of it is legitimate business recovery, compounded by interest rates rising, and we'll get into some of that, I'm sure, compounded further by geopolitical uncertainty, which remains absolutely present. But some of it was just a hard pendulum swing back to the basics of running a business and building a business. And I think that's where we all need to focus, because it's the incremental putting your one foot in front of the other, building your business, retaining your customers, aligning your resources to produce a great return for the dollar of investment that you put into it, that's gonna produce the ultimate growth gains over time. So I am optimistic. I don't think that's entirely the party sentiment here yet, but I do think the long-term trends are absolutely incredibly favorable, and we just have to have the right horizon perspective to find that optimism in today's market.
I mean, drilling on the interest rate issue, how much is that the kind of organizing principle that you view as you look at your business?
So, we're an equity investor. Our cost of capital is far above, the cost of debt. But we also invest in businesses that are growing and transforming themselves. And so we don't use a lot of leverage in our approach to, financing companies. So it doesn't have a direct impact on Clearhaven's investments in terms of the deal structures that we look to do. It does have a direct impact, but it doesn't have a needle-moving impact. On the other hand, it does impact our company's customers and their markets and their cost of capital and their businesses, which means that technology spend gets pulled back. It's what we all experienced in 2023 in various ways. And so indirectly, not so much from the deal standpoint, but from the company experience with their market standpoint, yes, it does have an impact. And it depends on, the market, how severe or lesser that is.
Yeah, I mean, it's a different time, I guess, than when we were more in a media, consolidation phase, where a lot of that was financed with debt and very inexpensive debt, and multiples looked fantastic. We're not really in that phase anymore. So when I look at our company, which is split between media and ventures, I'm kind of with Michelle. Most of our investments that we look at on the venture side, we might use some debt. A lot of them are equity-based, potentially, and so, yeah, we tend to see it a little bit more down, further down on the transaction side in terms of just other people who might be looking at debt components, or the company itself who might be looking at debt in addition to equity. Look, to the extent that we're considering that, yeah, I mean, obviously it makes it a little more expensive for us to structure something, but we have a lot of flexibility into how we structure things, so I don't know that it's had a particularly chilling effect on what we're considering on the venture side.
At least, again, from a vantage point of where we are as a company, what we've heard from investors is the pools of capital has changed. Obviously, if you look at it, because you have bonds, then you have public markets and private markets. Private was hot. You could just have any sort of valuations. Multiples were like over the roof. I think that's getting coming to what I call a tempered stage of, and kind of starting to mimic the whole public markets. And public markets, obviously, we've been influenced by the interest rates and the pools of capital that's coming to that. So to that extent, we're seeing that effect overall. I think it's a good thing for the market. I think truly it's coming back to where it should be from a hygiene standpoint, and hopefully this kind of sustains from here on, and you're not going to see another kind of a big enthusiasm to take it up and then coming down. So we kind of in a much more less bubble phase. I think that's super realistic to look at.
I saw some numbers that just from a M&A deal sense, maybe the overall number of deals is still not there, but it seems like pricing is starting to go back up. And so maybe that suggests that there's been a equilibrium or a recalibration of expectation.
Right.
I'm sort of curious to, I mean, as you, Michelle, I'll start with you, just your perspective, because you're looking at new acquisitions. Are you finding, is there a price gap challenge, or is it narrowing?
I would say because of the deal volume still being off, the N is not as sufficient as we would like to see. In other words, there's variability in the deal activity and the pricing of those deals. Certainly, incredibly high quality assets are still pricing at quite high multiples. But anything less than a fully pristine business has a lot of variability. You could get lucky, so a seller could get lucky and there could be a strategic home that, hits the mark for their ask, but I'd say there's generally still a bid-ask spread, and some of that is because the last rounds were priced in a really exuberant market environment that is not relevant for current market environment, and so investors need to rationalize the headline challenge. Even if those deals had structure and they were not full takeout values, there's a headline challenge that they need to manage if they're going to transact in today's environment at more reasonable multiples. That being said, we did spend time looking at the current market because there's, as we think about, again, just staying on the video software side of things, there's quite a lot of variability in the multiples out in the market as well today. Obviously, everyone's kind of off the peak, but we looked at it from the standpoint of profitable versus unprofitable video software companies. And when I define profitable for this analysis, I define it as 5% EBITDA margin or above. Below 5% EBITDA margin, it's not really producing cash flow. EBITDA is not really cash flow, although we use it as a proxy for cash flow. 5% EBITDA and above being profitable companies, below that being unprofitable in our definition. And there's about 15 true video software comps that we included in this set. The above the line, the profitable set is currently, and I say currently, it's March 31 data, trading at 2.9 times revenue. The unprofitable set is trading at 0.8 times revenue. There's a massive distinction there, 3 times plus the multiple, if you will, for profitability in the public markets. And I don't always agree with the public market valuations, but there's a clear reward for profitability. If you look at the growth rates between those two cohorts, it's 4% TTM revenue growth versus 3% revenue TTM growth, 100 basis points difference in growth. In other words, no difference in growth. The sole difference is in profitability. And that's pretty distinguishing in today's market. Baskar, to your point, and I like the term hygiene, it's about the hygiene. Do you have a sustainable business model that will scale? Ultimately, remember, we got to produce cash flow here. Although revenue is nice, if it doesn't produce cash flow, then there's not going to be an ultimate value. So I think that's what you're seeing reflected currently in the, the public comps. And I think some of those unprofitable companies are on the journey and they'll get there, but the market's not going to reward that until it's really, cash in the bank, so to speak.
I'm curious, Baskar, I mean, you raised money in 2 years ago, and
2021.
2021, publicly reported at a $1.4 billion valuation. Right. Hats off to you and your team for scaling the business. Right. I guess my question is, how did you scale it so quickly, and how do you now balance kind of carrying around that valuation as the markets have kind of changed?
Right.
And
Absolutely.
Now you gotta go back to the market at some point.
Two aspects, Richard. Again, just to kind of go back to your stuff, I think as a company, we're children of the markets. The markets were transforming. We were at the right place, right time. Broadcast migration was starting to happen, where we had the right product market fit. That's kind of helped us out. FAST, which is the ad-supported streaming model, was evolving. We're the leaders in the market today because we just was the basement of the whole evolution of that whole market. Pretty much kind of dominate the market in today. And that's been great. Some of them have been lucky, to be fair. There is some strategic stuff, but literally it's also about being in the right place, right time. That's helped the company to grow. We continue to see growth. And for us, again, growth rates should be about 25 to 30%. Because that's because we truly believe in high growth models in terms of driving innovations and what we try to do. So that's what we're really focusing on. Coming back to the whole valuation question, for us as entrepreneurs and founders, I'm looking at it in the next decade journey. Actually, what it matters today actually has no value for us. And obviously, it's valuable for our investors when we go IPO. And that's a couple of years away where we're looking to do that. I think that's where the rubber meets the road in terms of what the valuations are and what the market's ready to really provide to that extent. We don't totally even look at valuations. The reason is we're really focusing on growth and profitability. And like what Michelle pointed out, I think fundamentally we are really looking at the rule of 40. Rule of 40 is a SaaS metric, which essentially has it's two aspects: growth percentage plus free cash flow margin percentage. Obviously, EBITDA is another surrogate, but literally FCF percentage. If you take that, if you add those two together, is the rule of 40. So you could have 20% growth, 20% free cash flow margin. That's a great business to be in. You could obviously have a 5% EBITDA margin with a 35% growth rate. But today in the market that we, at least the sort of the conversations we're having across investors is that we need to balance these two. We cannot have one or the other. I think if you look at the crazy days of 2021, you could have, I've seen companies which do 60%, 70% growth rates, but with a negative 30% EBITDA and get away with that and saying it's a rule of 40 and got the premium that the whole high growth businesses were having. But today, when I talk to investors, largely it is really rule of 40 with a very good balance of growth and profitability. So profitability, like what Michelle's pointing out, at least in our view, it should be about anywhere from 15 to 20%. And growth should be somewhere in the 20% and above, 20 to 30% is a good growth curve. That's sort of the target that we're really working with. For us, the plan is next 3 to 5 years, can you really maintain the 25, 30% growth rate with the 15, 20% EBITDA margin? I think that's going to be the way to grow. So we're not really looking at valuation as at least, and our investors are very new to the business. They just come in a couple of years back. They're not looking to exit right now. So to that extent, the valuation is it 1.4 or 1.3 or 1 or a 1.8 actually has no value today.
Just to add a data point on that, because rule of 40 is a helpful heuristic, folks use, as Baskar described, and it's not the be-all, end-all metric, but it is a helpful heuristic to describe those two important factors. In the analysis I was describing earlier, the delta between the rule of 40 companies in the profitable cohort versus the unprofitable is more than 30 points. So, it really does, that combination does matter significantly to valuations, and you see that now reflected more ubiquitously in the market, whereas that wasn't as true a couple of years ago. It was growth at all costs.
And again, there's no rocket science in the numbers, right? So it's what are we looking at is if you really do a DCF of some form, you need a mix of growth and EBITDA. And because you're not going to exit today, you want the growth and you want to see the EBITDA percentage kind of maintaining over time. I think that's what's driving it, and investors just working backwards from that number. Rule of 40 is a much more easier way to thumb rule to get there. Right?
And you need to kind of, as you kind of project your growth, you have to balance what's organic, what the markets I'm in, what are adjacent markets.
Correct.
Looking at, obviously, we're talking about M&A as well, looking at ways to kind of add to your platform.
Absolutely.
What I'm curious, and all of you, to get perspective on how do you view that organic growth versus acquired growth kind of balance?
I mean, we really are a conglomerate. I mean, we've been very M&A focused for a long time. But on the venture side, we've been almost the opposite. We've been a minority investor. We've done things outside of media, outside of streaming. I'm trying to stick to streaming. We've done things like pet cremation and funeral homes and sign companies and.
Is that pet cremation a SaaS business, or is that
Subscription.
subscription? Okay.
Probably a little of both. But
There's a lot of churn there, though.
But interestingly, I think as we've thought about our venture side of the house, going forward, we're probably much more apt to make control M&A investments. I mean, we want to consolidate the results. We want to build platforms. And so we've kind of 180'd, and even though we haven't done much since we split the verticals, I think we're more focused there from an M&A perspective than we were before. And I couldn't agree more with what the other panelists said. I mean, we too have put a premium on companies that are cash flowing. Not only because in the near term you're mitigating some of your risk and you're maybe getting a little more bang for your buck, but just the cone of possibility. We're long-term investors. We've been around a long time. I still like knowing that 10 years from now, the projectability of an entity, you just feel better about a company that's profitable now. Mm-hmm. And so you can invest with a little more conviction. Now, I don't like paying heavy premiums, and so a lot of what we do is try to nose around things that maybe PE hasn't. For whatever reason, lots of reasons why PB might not be interested in certain things, but we've have completely, I guess, a lot of our focus is on profitability these days in terms of not just investing, but M&A.
In my old job, I was at a tech company, and we did a commercial deal with Sinclair, which was a great technical partner. Obviously, we're at NAB here with a lot of tech companies, streaming tech companies. My sense is that's not necessarily a category you're going to buy versus more create a commercial relationship. Would you invest in tech stack? And I guess what would compel Sinclair to want to own that component of their business?
So we've done things several different ways over the years. And from a pure, I guess, venture perspective, a typical transaction for us over in the last 10 years has been some sort of, I call it a seed or A-round investment, part and parcel with a commercial deal. That's worked out really well. We learn a lot. We obviously get a service from it. We kind of morphed that structure to more of a fund-to-fund because we're not really a VC, and we weren't seeing as much as we wanted to see. So we deployed capital with a number of funds to get smarter about things like VR, AR, ad tech, MarTech. And then, sure, we have co-investment rights. When it's been very core to what we do, we've been much more apt to try to control it ourselves. So when we consolidated a number of television stations, we built our own VMS, CMS platform just because we wanted full control over what we did. When it's maybe ancillary to our core or maybe a little more exploratory for us. We've been much more likely to just execute a commercial agreement like these guys, or that sort of hybrid model of investment and commercial deal. Going forward, I think we're probably wait and see on certain verticals. Again, we're probably much more inclined to do M&A versus seed or an A round these days, but we tend to let our business needs dictate some of those decisions.
Makes sense. Michelle, you guys have a couple companies in the video space, Sunday Sky and Wowza. Obviously, you've said that video is a part of your thesis. What attracted you to those companies, and how has it gone? It's been your relatively, what, 5 years? No, how old is your
5 years.
Yeah. And so, where are you in those companies? Are you adding on? Are you here today? Looking for complements to those platforms?
We're always looking for complements and new platform investments. So, that's just our business. So definitely always looking to meet interesting companies. Our model is really most typically a majority investor where we partner with management teams, and where we partner with them, it's typically at an inflection point in their growth journeys. Often on the back of kind of founder leadership up to a certain point, but to get to the next level, they're looking for a partner to help scale. And as software investors, and frankly, I've spent more than 20 years in this strategy, we bring a perspective of what good looks like to companies who own their competency with their products and their markets, but we bring perspective on their business models in a way. So yes, we invested in Wowza, we invested in Sunday Sky, both are in our video theme. What attracted us to those companies is why the theme exists in the first place, which is the proliferation of video. It is the most compelling medium of communication outside of live communication face-to-face. And the long-term demand factors are, truly demand factors for software tailwinds. And that was, that's sort of the highest level perspective on it. But the other elements are related to the technology itself. It's not easy to do video well at scale. And as a result, if you have built a great product, we believe the market is significant, and there's a real opportunity for those companies to continue to grow. Now, to do that is not easy. Not only is the technology hard, but building businesses is difficult. You guys all know that, and many of you are business builders in the room. So our partnership model helps, frankly, avoid speed bumps and pitfalls. We've made a lot of mistakes before, and our companies have made a lot of mistakes before. So we can help avoid those mistakes for our next investment, and they'll make their own original mistakes, as I like to say, but at least we can kind of avoid the repeated ones. So, the theme around video, that it's not, we're incredibly bullish on it, and doing that well at scale, that's hard to do. So we look to identify the players in a complicated ecosystem who have differentiated technology, where we believe there's a moat around their products and their markets, and we come with a positive bias toward their markets.
That's terrific. Baskar, you bought, it seems like the last 2 Novembers, if my notes are correct, you bought Streamwise in November 22 and Telio in 23. What can we expect this November from? Tell us about those acquisitions and what attracted you. And again, you're not private equity, so there's probably some similarities, but yet it really needs to attach and help you with the growth that you described earlier.
I think our thesis is fairly straightforward. So if you look at it, M&D is a vertical business, and we are a vertical SaaS company. So essentially, the TAM of the business is limited by the vertical, the business itself, literally. And if you want to do that, you want to map the moats of this business and start to kind of look at adjacencies and kind of build the whole capability. Either it's buy, build, partner, and you have to kind of fix the strategies to figure it out. So what we've evolved internally is some sort of a periodic table of this business, literally kind of put together all the blocks and figuring out what are the moats and what are the adjacencies and how do we want to kind of play this whole thing. So essentially, for us, it's actually two specific set of interests: follow the workflow of our customers. so that we can increase the share of wallet that we are actually able to get that customer base to kind of spend with us. Second is follow the money, essentially help our customers. How are they making money? How can we be part of that whole value chain for them? Those have been the two drivers. We continue to use that as the basic compass, if you will, in terms of taking decisions, in terms of what sort of companies we look at. Having said that, obviously we're trying to overlay that with the need for growth and profitability balances. And as we go towards IPO, for example, we've been kind of shy of taking a lot of EBITDA negative companies because that just sort of makes it harder and kind of delays the overall the public listing to some extent for us as a company. So that's been the kind of balance that we kind of really playing with. Two set of steps we're looking at. One is tech tuck-ins. Tech tuck-ins are more simpler and easier to get in, and kind of we build it over the tech tuck-ins and use our go-to-market to kind of drive that growth. Other is really revenue creative aspects that we're trying to look at. We've not been successful in really building at scale revenue creative companies which you can pick it up. And obviously we are a software cloud first company, so we want on the cloud. So that's been a hard problem with the growth rate and the EBITDAs we're looking at. So that's been I think industry, it is a hard industry to that extent to get that value.
Sounds good. Scott, I want to ask you, you guys sold Stir, small streaming service that you had. Curious, was that you also, on the other hand, you have Tennis Channel. I'm just thinking about kind of businesses into the streaming side of what you do. Tennis Channel, obviously, you're doing a lot of different articulations of streaming and TV Anywhere and all the different flavors that we have. But Stir didn't survive at Sinclair. Any insights on that?
I mean, in a way, it was a little bit.
Maybe it's helpful, I'm sorry to interrupt, just to describe what Stir was for the audience.
Stir was an AVOD platform, started pre-COVID, and we built it internally, tested all sorts of content that we controlled through there. Probably one of our earliest forays into fast channels.
Yeah.
And so we had a number of nascent streaming efforts. Like News On is another example. News On is exactly what it sounds like. It's a news-focused streaming platform, local news. Lots of broadcasters participate. We actually purchased it from a consortium of broadcasters and brought it into Sinclair. There was some overlap between Stir and some of its content and News On. I think News On had a little stickier audience, and we looked at the proliferation of AVOD platforms and how various other companies were positioned, and just made a strategic decision to focus on other assets. Tennis Channel has had a SVOD platform for a long time. T2, which is certainly has a heavy streaming element, launched last year. That is a multi-platform initiative that does have a linear component, has a streaming component, and just from an internal development standpoint, can very easily leverage Tennis Channel's infrastructure very economically. And so Stir was sort of the odd, I don't want to say person, but odd platform out when it came to just some of our strategic initiatives. And again, there was some overlap there, so made sense to find it another happy home.
I'm curious, do you look at, when you think about the Tennis Channel with a kind of traditional MVPD, you've got the TV Anywhere, you've got FAST, you announced what I think is kind of interesting as well, a 3.0 over-the-air distribution. So you've lots of different ways that you can access consumers, you can sell advertising. What do you look at the kind of the unit economics and sort of help try to guide the audience, or is it just meeting them where they are?
This is a great question because this is obviously what we wrestle with every day from a strategy perspective. I think and we're no different, by the way, than what we expect from companies we look at from an M&A perspective, right? We'd like to be profitable too, and so when we weigh decisions about how to deploy capital, ideally, everything we're doing from a multi-platform approach has, some responsible financial models behind it. And in a perfect world, there's very little overlap in your audiences, right? Like I think when you look at our tennis strategy, we're definitely trying to find, pockets of tennis fans that we're not picking up on linear tennis channel. And so even our SVOD, right, is only going to attract a certain cohort. And so T2 is really aimed at picking up incremental audience. And again, because we're leveraging a lot of the content we already have rights to, it's a very reasonable investment. At the same time, we're looking at streaming opportunities internationally for tennis. And again, that's a little bit of a different animal because there are, a different subset of rights you need to acquire. But I think we do approach it from a platform by platform perspective in terms of analyzing, what a particular expansion would look like just from a financial perspective.
I wasn't going to raise the P word, but I'm going to raise it. Pickleball. Are they doing pickleball?
I love pickleball. We just launched a 24/7 pickleball channel, which it's awesome. If you love pickleball, you're going to get lots of pickleball. Same thing, right? We started with a linear component on Tennis Channel. Obviously, there is if anybody is into racket sports, pickleball is like taking over any tennis facility you go to.
Any city park. I'm in New York City.
Park.
Every park has pickleball.
So we entered into a joint venture with another entity to source all the rights we need from a content perspective, and that has gone a little bit differently. I don't know that you'll see a 24/7 cable network dedicated to pickleball, but if you turn on your Samsung television, you can get PBTV, and that'll push into other platforms as we move along. But yeah, it's a great example of in this world, like how easy it is, relatively speaking, to sort of leverage what you already have to spin up something unique and get it out to millions of folks with, again, a very, I think, responsible expense load.
Yeah.
We are the back-end technology for the pickleball, so
There you go.
we run the tennis channel and the pickleball channel as well.
So shifting gears, Michelle, as you look at new acquisitions, what sort of metrics, either revenue, EBITDA, would some company need to kind of come in the door at Clearhaven?
So we invest in what we'd call kind of the lower end of the mid-market. So our companies are typically, well-established, diverse customer base, well past the product market fit question. They don't necessarily have to be profitable when we buy them, but we believe that profit and growth are what good looks like together. So if we're investing, it's because we see a path to that. So they don't have to be profitable. From an ARR standpoint, at least 20 million, that and up is where we invest. 20 would be on the low end for us currently, but where we see an opportunity, and we tend to focus on, back to the organic versus inorganic question you asked earlier, Richard, we tend to focus first on the organic growth prospects of our companies. What can they produce? And when we talk about Rule of 40 metrics, we're really talking about organic growth only in the growth part of that metric. So we start there, but if we see a platform that we could add on through strategic acquisition, not roll-ups, we don't do those kinds of investing styles, but strategic acquisition to expand the footprint, expand the market opportunity, we might start lower, but then add on and create a business of more scale over time.
So did Baskar ever come in? Did you ever look at Amagi?
We did not look at Amagi. I'm sorry we missed it.
One that got away. So Baskar, tell a little bit more about your business. When I think of Amagi, I think of sort of the fast channel phenomena and how you guys have been like the go-to company for media companies to kind of get get going, you've got to grow, you need to be in other businesses. You've got to, how are you servicing, whether it's broadcast or other parts of the media ecosystem, to continue your ascent?
So externally, Richard, again, the way people look at us is like a fast technology company, but that's just about maybe close to 50% of our revenue. So other 50% comes from broadcast migration. A lot of our customers are large enterprise broadcasters worldwide who are starting to move their media operations from on-prem to cloud. And that's a big transformation, and I think it's just getting started. I think the early adopters and visionaries are companies like Sinclair and NBC and others, but we're seeing a huge amount of progression in terms of a lot of other companies wanting to mimic those successes and kind of start to build it on top of it. So essentially, that's been a big trend line for us. And the idea for our customers is the world is changing for everybody. Pay TV it's not cratering today, but it's kind of starting to decelerate. Although a significant amount of the revenues are coming from that. So one of the big motivations for our customers to move to the cloud or to a virtualized infrastructure, essentially being able to have a unified media operations independent of the distribution models that's evolving. So they would like to take it on a CDN path to a direct-to-consumer. They would like to take it to an aggregators of OTT aggregators, or they would like to take it to pay TV, satellite, cable platforms. And all of that looks and feels the same in terms of the media operating environment and having uniformity across. That's a big driver for a lot of our customers to move on. So
sounds like Sinclair, right?
We are migrating our stations into the cloud.
Yeah.
Absolutely, yeah.
But the notion of the fewer vendors, the fewer platforms that you touch, it just gets easier, and it's kind of reducing friction for
Absolutely.
Media companies to,
Absolutely.
encode once and just distribute or whatever it might be.
Absolutely, Richard. Again, the biggest trend line for us, and again, in the last 3 years, has been like omni-channel distribution. Essentially, every content creator that we work with today is looking at, can I get my piece of content to as many consumers wherever they're watching that content in any form and fashion, that we can actually both show the content and also monetize the content in different forms and fashion? That's been a big trend line. Versus if you look at 2018-19, people thought, let me create a D2C app, I'm off to the races. And the cost of acquisition has been so high, and churn's been very high on that business. So everybody's looking at an omni-channel. I think that's where the resilience of this business is starting to really come up for us.
You support various ways of doing monetization, but you're not doing monetization for media companies, are you, or you're not?
We're very leaning towards ad-supported models, essentially. So everybody who wants to do a targeted advertising infrastructure across the whole thing, live, linear, VOD, whatever the form and fashion, we support that in a big way for our customers today. And that's been the bread and butter of how we support today, yes.
We have time for a couple questions if anyone wants to go ahead. Can you identify yourself?
My name is Will. I work for Pro company. Nobody mentioned the big wave that's going on, which is AI technology. So how do you guys look at, from the investment point of view, the dynamic and how does it?
Let me just repeat the question so the question is how do we evaluate generative AI, and just, I think, really from my 2 days here at the floor, I think looking at some of the ways AI is being implemented has been some of the more interesting stuff, but it's hard to know what's really AI or what's not, but curious to get your perspective. Michelle, you were talking a little bit before the panel.
We were told not to mention those two letters together, so that's why it didn't come up. No, I mean, it's hard to get out of a conversation these days without talking about it, so thank you for making sure we didn't. So we invest in businesses that are well established. So in terms of investing in an AI company per se, that will not be what we're doing. However, we're investing enormously in AI across our portfolio and in our firm as well. Our portfolio companies are using AI, and we believe it's quite revolutionary. It's foundational technology that will accelerate a lot of industries and disrupt other industries. Our companies are using it in their product development, They're using it in their products so that, just to give you an example, in our video portfolio, Sunday Sky's video creation platform for the enterprise arena, and they use it to help a business with a simple prompt create a first draft of an enterprise grade video that's branded, that has some of their key messaging. It saved hours of time, and that hours of time from their original platform was saving days or weeks and tens of thousands of dollars in terms of an enterprise video creation originally. So it's really decimated the amount of time that it needs to take, which is a good thing for our customers' productivity. So we started to inject it in products and ultimately in in a number of ways within our businesses, and we'll continue to do that indefinitely.
AI?
Yeah, but again, we don't talk about AI. This is the whole idea again. And again, personally for us as a company, I think we look at it in two lenses. One is customer lens and one is a technology lens. From a customer lens standpoint, truly we believe that what's the value that we're adding to the whole thing? So it has to bring in some sort of productivity value of some fashion, either cost or performance or any of those should really change. And we're kind of going through that journey with our customers. Obviously, we have do products like what Michelle's pointing out. A lot of our products are getting enabled at the back end, but we don't talk about it as AI. We just talk about it as it's a good magic element at the back end, which actually allows this. So that's been a very conscious call not to hype it up to some extent. So that's been a big reasoning. From a tech standpoint, I would like to also delineate a lot of the companies are AI application companies. Everybody's building on some sort of a ChatGPT variant on top of it. That's for us not core AI. So we're doing some foundational work on the AI part as well. But again, not yet something that we're for the media specific part of the businesses as well. So we're looking at technology from two threads. One is what's the application element, what's the core technology elements that can actually be very differentiated that you can actually build from a core tech standpoint. Business standpoint is really for customers is what's the value and what's the willingness to pay. I think that's been another part of the exploration that we're going through with customers is are customers ready to buy AI and what's the good reason for them to do that, right? So.
Scott, you have anything you want to add?
I mean, we have a department that focuses a lot on, internal application of AI before we're worried about how we're going to deploy capital against it. And I think we're still firmly in the realm of what's the impact for our day-to-day operations from just a news production standpoint. How can we best leverage technology to make our operations better, more efficient, et cetera? And then thinking about the future impact before we consider whether or not it's a vertical that we actually would invest in or just have commercial agreements.
Well, I think we're out of time. Thank you all for participating and being part of this discussion, and thank you as well. And I'm sure next year we'll be here with more optimism and discussion of deals done, and look forward to it.
Yeah, thank you.
you.
Thank you very much.
Thank
Thank you.